All right, we have Pete here again with us today. He is our financial advisor. And normally we do like conversations back and forth. He's been coming on for the last few months. And what I want this one to be about is I want to just pick your brain, Pete, about life insurance. A lot of my clients either they don't have enough life insurance, they have questions about life insurance, and I that's what I want today to be about. Is that okay with you?
Absolutely. I can talk all day and then some.
All right. So, the very first question I have for you is how do you figure out the right amount of life insurance to have on yourself or your family?
Great question. So there are a ton of calculators all online. Most insurance companies will have a calculator you can go to. I have a calculator on my website, a simple one and a complex one. It depends on how much detail you want and figuring out the need of the amount of life insurance. The need is in a sense based upon the lost revenue from the spouse or the business owner. So, for example, if your spouse is generating 100,000 a year of income and contributing that to the household, and they died, then how much money do you need to replace that 100,000 a year for what time frame? So, if you need to replace 100,000 a year for 1 year, then the math is simple. 100,000 is what you need. But if you need to replace 100,000 for the next 15 years while the kids are going through growing up in college and meeting all the goals, then that 100,000 obviously goes much higher, probably close to 1.5 million to 2 million of need to generate the 100,000 for the next 15 years or so.
Wow, okay. That's really good information. Thank you.
Yeah.
Well, what if we have a stay-at-home mom? Do we really need to get life insurance put onto her?
Oh, one of my favorite topics. Thank you for asking this. When I insured my former wife years ago, the insurance company came back to me and said, she's not making any money. Why are we insuring her? And here was my reply to them. And now I give this reply to anytime an insurance company inquires why I'm insuring a stay-at-home parent, I'll say. Issue number one, I like to say is imagine if my wife passed away and I've got kids to raise. Now, there's a couple of things I'm going to do. One, I'm going to go find the next youngest, cutest girl I can find to be the step parent to my kids. In which case, I'm going to have a ton of therapy to pay for my kids because they are going to be messed up. Or two, I can go out and hire a nanny to help take care of my kids. But I'm pretty sure the nanny at 15 bucks an hour is going to be a much different nanny than 30 to 40 bucks an hour at a minimum. And how do I manage the numbers here? Now, I say this facetiously, I am joking, but there's a hint to reality here, right? How many times have you seen people out there, husbands especially, guys, not to pick on you, but if the wife passes away, the guy's off to the next cutest girl. I mean, come on, right? And how good can that be for the kids? I mean, just look at the statistics in society. So, in my opinion, you go back to the calculator and you say, what's it going to take to replace that person? You've got emotional, psychological, physical needs of the kids, of the household that needs to be replaced from that person who's not making any money. Now, I bet if you do the calculations that I do, you'll find that that person's probably worth a good 80 to 100 grand a year. And so having 1 million to 2 million on a spouse who's home taking care of the household and the family makes all the sense in the world to me if the surviving spouse wants to maintain the lifestyle and the goals and everything. Now, some of you are going to come back and say, "Oh, yeah, that's great, Pete." So now the husband. Let's reverse it, right? The husbands like to say all the time, "Well, I'm not going to have 1 million on me. Give me a break. Why should I leave 1 million for her to, for some guy, for my, my wife to have some guy, live off the 1 million bucks that I leave." Get over it. I mean, it's not the guy. It's taking care of the family. It's honoring the commitments that you made. And this is just all part of financial planning. It's running those kind of numbers. So yeah, I'm a little facetious when it comes to this one, but I'm a big believer. Uh, the stay-at-home parent, the stay-at-home mom, stay-at-home dad is extremely, extremely valuable to that household. Emotional needs alone, that the working, the working parent doesn't necessarily bring to the table. I mean, quick side note, can you imagine as the working parent, you're out all day and the kids come home, they had a bad hair day, they got, bad grade, got yelled at by a teacher, whatever, they're having an emotional meltdown, and you got that parent there nurturing and taking care of that child. Meanwhile, the working parent has no clue what's going on till they get home at quote unquote dinner time. So there's a huge value, and one that I believe everybody who's staying home needs to have.
That's really great points. Thanks for sharing about that, Pete.
Yeah.
So, my next question is, what about the kids? Some of my clients are telling me that they have life insurance even on their children. Is that necessary?
Well, necessary is interesting word. I don't know that it's necessary. I do think it's valuable. Now, we don't want our kids to pass away. So the first thing we have to get over is, oh, really? You're just hoping your kids will die so you can make some money? No, that's not what we're doing here. Okay. When you purchase insurance, life insurance, especially on kids, the insurance companies are going to more than likely predominantly focus you on a cash value type of a life insurance policy. And when you go to a cash value policy, you're picking up accumulation options. So you can use the accumulation inside that policy for future costs, for college, for medical expenses, for cars, weddings, whatever you need for the child. So on one side, it's a good savings account. Yes, there is a death benefit associated with that. And it pains me when I see people who lose their children. And there is a strong emotional impact when that happens on the parents and on the family. I know this sounds it's hard to say, but having that life insurance there gives them a lot of freedom to be able to grieve and mourn. Maybe if it's $100,000 policy, well, that 100,000 can go a long way to therapy, go a long way to giving and gifting to people, whatever the family wants to do to honor that child if the honor passes away, if the child passes away. And then the final reason is I would pick a policy, cash value policy that has living benefits to it. Because in addition to children passing away, which is tragic, we have a preponderance number of people coming down with illnesses, cancers, and things of the such. And lots of policies have what's called living benefits, and the living benefits allow you to utilize the death benefit in the event of a critical or chronic illness. Now we have another reason for insuring the children, because God forbid they come down with, let's say, a cancer. You can actually turn the policy in. Let's say it's $100,000 death benefit. You can turn the policy in and receive a large portion of that 100,000 in cash for you to use however you want. Doesn't have to be used to pay the doctor or the hospital or the cancer clinic or whatever. It can be used, it's cash and bank. Now you give up the policy, but you get the cash. And that's a huge advantage to the type of life insurance policies that have living benefits to them. So that would be the reason I would have it on the kids.
Okay. So, I'm going to switch gears real quick. Um, my stepdaughter Anna, she got cancer when on her 15th birthday
Mm,
actually,
I'm
and
sorry.
we had a cancer policy and we still
Hmm.
do a family one,
Hmm.
and that was the best thing that we could
Hmm.
have ever had. Like it gave us so many like I don't know, hundreds of dollars each day she was in
Hmm.
the hospital. And that really helped with all the medical bills and then just the time off and everything. And it was really good.
You
So
bet. Good job. And I'm
thank you.
sorry.
So would is that just as good as a life insurance policy that's cash value, or is there a difference or
Apples and oranges. So those cancer type policies, those critical or chronic illness standalone policies are great. There's companies out there, you all have probably seen the advertisements from the duck, right? Aflac. There's other companies, Columbus, I believe, is another one out there. Those policies are really great policies for providing immediate cash in the event of a critical or chronic illness. And big fan of them. I think if the cash flow allows to use them. All right. The life insurance is a little different animal. Again, apples and oranges, a little different piece of fruit here. It's predominantly driven by the death benefit, and the payout is directly determined by the change of life expectancy, which is different underwriting than the peril of a cancer or a broken arm or something of that sort. So it's a different way the underwriters are looking at why the benefit would be paid out.
Okay. Great. Thanks for answering that one. That was just kind of
Sure,
a me personal question, but thought other
sure.
people could benefit from it.
Ask me
Okay.
anytime.
Another question. So, what are the different types of life insurance policies, and when is the best time or purpose to be able to use them?
Ooh, good question. So let's go over, you may want to get a notepad out for this one. This one's kind of fun. So let's go over the types of policies. In the broadest sense, 100,000 feet up, there's two types of policies. There's what's called a permanent policy, designed where premium payment is made typically for the lifetime of the insured. And then there's a term policy, which is designed that a premium payment is only structured for a set number of years. So a term policy is typically very low cost that you can get a high benefit from. So for example, I work with the business owner and they're taking out a loan and the bank wants to secure that loan on the business owner for, with a 5-year structure on the note. Well, we would use a very simple basic term policy that is designed only for premium payment for 5 years. It'll be a very low cost with a high death benefit, and in this particular case the bank is named as the beneficiary so they can get their loan back. In a family situation, I would use a term policy, again, very low cost, high death benefit. Number one, when there's low cash flow. And number two, when we're looking at, maybe the next 18 years, if we take a child's not life expectancy, I'm sorry, we take a child's time in the household, right? So 18 years is a long time to be paying for insurance without having some sort of a benefit at the back end, which I'll explain in a minute. But from a cost perspective, you're paying a very low cost for a high return in the event of death. If you add in what I was talking about a minute ago about living benefits, if you get a term policy with living benefits, then you get the added protection that if they come down with one of the triggers on the living benefit policy, critical or chronic illness, that policy could pay off for that as well. Okay, so that's term. The other types of policies are under the umbrella of what I call, not what I call, what is called cash value. And now there's four types of cash value policies that exist. Okay. The one that we've heard that's been around forever that people like to use is called whole life. Whole life was one of the original cash value policies that insurance companies came up with. Whole life policies are literally designed so that the policy will stay in force to the insured's age 121. Most people aren't making it to 121, but the policy priced so that there's guarantees that the policy will be there through that time frame. Okay. The way they price it is based on what's called mortality cost, the cost of everybody in the pool, the chance of the people in the pool passing away. They cost it, they price it based on their interest rate that they'll earn on their investments. Insurance companies are very conservative, so they're buying things like buildings and T-bills or things that are guaranteed very low interest rates, so they don't pay out a high interest rate, but those are guarantees. And when you're buying a whole life, you're really purchasing guarantee that this is going to be here, that policy is going to be here. Insurance companies hire really, really smart people. They're called actuaries. Actuaries are brilliant people. They run circles around me, just sitting here, right? They're amazing people. And the insurance company went to the actuary and said, well, how can we do this? The consumer wants less cost, but we've got to make sure we provide. Because the last thing in the world the life insurance companies want to do is not provide the death benefit, right? They contrary to popular belief, they don't want that bad reputation. Okay. They want to pay it out, right? They want to be there for the consumer. That's what they're here for. So the actuary said, okay, well, tell us what you want. And the consumer said, here's what we want. we don't want this guarantee to age 121. We ain't going to live that long, right? And for God case, please don't charge us so much for all the expenses you think you're going to have, because they build that into the cost of the policy. So the actuaries came back and said, okay, tell you what, you tell us what you want, how long you want the guarantee. We'll give you a fixed interest rate, but we'll vary the guarantee portion. So if you say, look, I don't want a guarantee to 121, I only want a guarantee to 80. All right, we'll guarantee it to 80. Logic will tell you that's a lesser cost. That also should tell you that if you live beyond 80, they are not going to give you a guarantee. But they'll give you a guarantee up to 80. Well, I don't want 80, I want 95. Okay, we'll give you the guarantee to 95. And so they really respond to the consumer and build what's called a universal life platform. And a universal life is a fixed interest rate, tends to be a little higher. Sometimes it varies every couple years than the whole life, but the guarantee only lasts to however long you want to guarantee it. Okay. Well, the consumer said, Yahoo, this is great, until the market started screaming in the 80s and 90s. And the market started screaming, and the consumer again said, I can go over the stock market, and I can invest in mutual funds, I can invest in stocks, and I can get a bazillion rate of return over there. You got to do something about this interest rate. So then, again, they went back to the actuaries, and the actuaries sharpened their pencil again and said, tell you what, we'll build a policy that allows you to put some money in, have the money invested in the stock market inside the life insurance so that you can get the rate of return of the market on the universal platform. Well, this is kind of the cat's meow at this point. This is really great. You mean to tell me I can get basically stock market returns? We call them sub accounts, stock market returns, and I get to choose how long I want the guarantee. And then, of course, with cash value life insurance, I didn't mention earlier, all the gain inside a cash value policy grows tax deferred. So you're telling me I can get all of that gain on a tax deferred basis, and if I do it right, I can get all the gain tax free and have the return of the market? Yeah. And so the insurance company said this is great. They built this universal platform, and they called it variable universal life. And it was a great platform until 2008. And you all remember what happened in 2008? And so a lot of the value inside the cash value policies, since they were tied to the market, plummeted. A lot of people lost a lot of value in the market, and a lot of people lost a lot of value in the life insurance policies because they were tied to the market. And the consumer said, well, no, wait a minute. We don't like this. Wait a minute. We want to get the return of the market, but we don't want any downside. Really? Excuse my sarcasm, but it's like you want your cake and eat it too, right? Well, again, who's the smartest people in the room? And no offense, Kristen, but it's not you and I. Well, it is you and I, because you and I are the smartest people among people in the room. But if there's an actuary listening in, and an actuary in the room, they're going to be the smartest person in the room, because the insurance company said, okay, hold the phone. Now you're telling me that you want the return of the market with no downside risk. And the consumer goes, yeah. Smartest people in the room, they figured it out. So they built the next type of policy, which is called an index universal life. And an index, or IUL, and you probably see these now advertised all over Facebook, all over the world. IULs are a great cash value policy. I particularly think they're fantastic. And what they give is they give market returns, but it's not tied directly to the market. Okay. And guarantee of no downside risk. So you can invest, you can put your money into the cash value of this insurance policy, this IUL. The market could go up 20%, they'll credit you 12. The market could go up 8%, they'll credit you 8. Every insurance company is different as far as how they credit. But the good news is the market goes in the wrong direction. It goes below zero. And these policies typically have a floor of zero. Some of them have a floor of 1 or 2%. So now they're, insurance companies, right? Just like everybody, they're trying to get your money so that they can use it and invest it, right? Everybody is doing that. Insurance companies, are capturing money using an IUL. So I'm a fan of IUL. I admire insurance companies for building this particular product out there. It really is great for the consumer. But let's be clear, it's a best of both worlds. Can't have your full cake and eat it too. If you want the full return of the market and no risk, and you're willing to assume the risk, then the variable product is great. If you want no downside risk, then you got to go with the IUL, but the IUL caps your upside. Now, people look at me and go, "Well, they're just keeping the gain on the upside." Yeah, they are in some cases, but if you do a research, if you look at the money, if you look at the rate of return of the market over the last 20 years, you will see not many upsides beyond the caps. And if you remove all the downside, you end up with actually a higher rate of return because you're taking off all the negative of which you have to crawl back up from. So don't worry. I like to think myself, I don't worry about losing the potential upside because there's not that many of them that you lose out on. I like that you have no worry about the downside, and it's the taking out of the downside that increases your actual overall rate of return. So cash value is the umbrella. Whole life was number one. Then came universal life. Then came variable universal life. And now there's index universal life. By the way, all of these policies, many companies out there are offering these policies with the living benefits as well. So you can get term with living benefits, cash value, and the four cash value policies with living benefits. If you're accumulating, if you're looking for a place to get tax deferred and tax-free accumulation vehicle, then a cash value policy works. Let me explain that real quick because people get a little bit confused on the accumulation side. Inside a life insurance policy, if you use a cash value policy, no matter which one of the four you use, okay, this applies to all of them. Any interest earned in that policy is going to grow tax deferred. And there are mechanisms built into those policies allowing you to access that deferral money, that deferred interest, on a tax-free basis. There's a real logical way that this is all done. It's all done by tax code, which is absolutely phenomenal. It really works for everybody. You just need to know how to use it. You need to know how to play the game. Final note on this, if you are going to use a cash value policy as an accumulation vehicle, which many people do and many businesses do, many businesses use either whole life or index universal life specifically to fund retirement plans for employees retiring off into the future. It's one of the best vehicles I think a company can use to help fund retirement planning on a discriminatory basis for employees. Okay. You can use it on a personal level as well. But the key is you've got to make sure you understand that it's got to be funded. Do not get called into a salesperson's pitch and do a minimum funding on it. You will get hurt into the future. If you want to know more detail what that means, call me. I'll be happy to explain it to you. In a nutshell, the logic should tell you the less you put in, the less you're going to get. So you want to be able to play where you can get that thing funded. Okay. If you fund a life insurance policy properly, you will benefit in the long run. Does that make sense, Kristen?
Yeah, this was really great information. Thank you so much, Pete, on
Well,
educating us on life insurance, how to calculate it, who needs it, and then the different types of life insurance. Um, yeah, this was great. Do you have anything else that you want to add that we
oh, I
forgot
could go
about?
on and on. I'm Italian. I can go on and on and on. Give me a microphone and you're gonna have to pull it away from me. So thank you for asking on this particular month on the life insurance. I've been doing this since 1992, and I'm a big fan of using insurance as an asset class. Obviously, number one, protection vehicle. That's the number one key. Protect the business, protect the family, whether it's the working spouse and non-working spouse, both working spouses, regardless of case, protecting the kids. Yes, it's tragic when we lose kids early, and it unfortunately occurs, especially with some of the things occurring in society today, drug and alcohol abuse, which, by the way, has been going on for a long time. Now we're just seeing more of it, unfortunately. It's becoming more, it's more prevalent in our face. It's great vehicle and a needed vehicle in the business environment. If you're running a business out there, you can use life insurance for a key man, key person type of insurance. You got somebody who's critical to the success of the company. You want to insure them. If you lose one of your best salespeople in the company due to death or disability, you'll want a life insurance policy so the company has the cash to withstand the time of the lost revenue and the cost it takes to get somebody else replaced in there. That goes for any top level executive or manager. So big reasons for using the insurance policies. Don't be afraid of them. Yeah, they're sold, and yeah, there's a lot of insurance agents who oversell them, but don't be afraid to address them as part of your financial plan.
All right. Thank you so much. If this was helpful to you, go ahead and hit the subscribe button, put in any comments that you have, and we will put the link to either get a hold of us or Pete in the comments. All right. Thank you.
Thanks, Kristen.